Kirk Spano here, Investing 2020s. Going to talk a little bit about our very short lists and then get into some of the trades that I am making this week on the option side and why I am doing them. So first off, this is the Dow Jones Industrial Average and other mega caps sheet in the very short lists. And there are several lists, our ETFs. There's about 80 of them broken up into different types. And then there's our mega caps and Dow Jones stocks. You have the dividend list, which is about 70 deep. And we have the growth list, which is about almost 90 deep. And I have a couple of additions. I made one today. I added Rivian to the growth VSL. I did not give a really big upside. I really am just trying to figure out what I think about it, but I did think it was worth covering. So we're doing that. Somebody asks where the risk ratings go. Well, I made those dynamic. So let's take a look at how to use the VSL. Let's just take a look at Apple. And it gives you all the basic information, market cap, humongous, price right now, price change, the year high and low, 3-year return, 1-year return, 6-month return, and then what the price trend has looked like for the last 3 months. And the reason why I use some of these ranges is because the 4 to 12 week range is pretty indicative of trends beginning and ending. So if you have studied the turtle traders or any type of trend following, you can take a look at these 3-month charts and even a 1-month chart and start to get an idea about really where the firmness in the price lies. 6-month tends to be a fairly tradable range. 1 year is really based on all of the analyst estimates out there. They all look 12 months out. And then the 3-year, which I think gives you a little bit more history. And I could put the 5-year on here. I just haven't. I do think these different time frames give you an idea of the strength of a stock and whether it's more secular, more forever, or is it more cyclical and you need to position trade it. So as I mentioned on Saturday, I said that there was only 5 forever stocks, and we covered the 5 forever stocks. And I'm going to write that article. I'm sure people aren't going to like it. They're going to say, oh, well, what about this one? And what about that one? And what about the other one? I really just don't think there are many forever stocks because they don't have the combination of things that you need, which is a big margin of safety, something that is inherent in the business that can almost exclude the possibility of going to zero or even losing 50, 60, 70%. A fortress balance sheet is a must, and underlying growth that looks like it's projectable longer than 5 years. And if you can project something out 10, 15, 20 years, even though the range of outcomes will be wide, if you know that it's up and to the right, you're just not sure how up, it's a pretty good thing to be invested in. So if you take a look at Apple, which is one of the 5 forever stocks, you can see not a whole lot of angst in this stock. I think the bottom fishing is still down at 110. There could be a market-wide correction. I might adjust this up a little bit. I haven't really played with the chart in the last month or so. This is from February, maybe. We can take a quick look. January 26th. So I will update this chart, and I'm going through all the charts right now, and we'll see. I think now that it's way up here, the question you have to ask is 200-ish the new support level? I doubt it. I think that this makes a lot of sense. I think that even down in here, there, and there, so at about 135 might be my new number. In fact, I would guess that 135-ish is going to be my new bottom fishing, just looking at this chart. So somebody said, I don't see a risk range on here. And actually you should. This is your risk range right here. Potential gain over the next 5 years. I have a bottom fishing price, which again, I'll even put that in there now. I just have to insert the chart. 5-year price target. What do I base that on? The 5-year price target is based on a range of other analysts. So I have a composite of 15 other analysts on this particular stock. Some stocks only have 5, 6, 7 analysts. So and then the micro caps and some of the small caps have 2 or 3. I generally don't want to get into a stock that has no coverage by analysts. However, companies that have light coverage, right, your early adopter analysts, the ones that are getting in there early, I usually like those for a couple of reasons. One, we're starting to establish a baseline for understanding the company, and we have something to compare to. So if I take a look at an analysis for Apple and it says that the 5-year outlook is $300, I can start backing out numbers just using Chat GPT or almost anything else and try to figure out a discounted free cash flow analysis. And then what I do is I apply whether I think the range of analyst estimates is about the right range, from low end to high end. And then I pick, if I think it's about right, whether I think the stock will end up closer to the high end or closer to the low end. And with Apple, I tend towards the high end. And I'll take a look at a chart to say, okay, where do I really think this can go to? So if we take a look at the Apple chart and we bump this out to weekly, right? Because you're not day trading, so you don't really need shorter. And I want to go all the way out to 2027 now. And there's a number of reasons why. I think by then we get a pretty doozy of a correction, even though that I believe the government's just going to keep juicing things so that they can generate tax receipts. So when we start playing around with the chart for Apple, we start to see a couple of things. One, pitch fan, which is usually a pretty good indicator of range, is showing that there is actually some inherent weakness in Apple that could manifest if basically everything goes wrong. We put in the pitchfork instead, you can see that the general trend is up. And I like that it gives me some support levels. So down here at 150-ish, that's actually pretty strong support. In fact, you see these two boxes here. Let's only go to 2026 and 2019, make the chart a little easier to look at. Pull it down just a bit. And we can see that this area, there's a lot of confluence in here, then really big confluence because you get two different measures, right? The different lines are different algorithms doing different things, but when they overlap, that's called confluence. And it points to these two areas here, which were, your jitterbug zones. It's where support and resistance, manifested. So I'd say probably 150 is bottom fishing price on Apple. Could it go down to 135, which I just talked about a second ago? I guess it could. That's the bottom of this area. And that looks pretty good here. The top of these ranges, right? Gap below here and it didn't like it. Cat back up and it stayed above so far. So a correction back into here probably is about as bad as it gets. I do think that I believe the whole super cycle idea on Apple for they're going to have all sorts of new telephones sold because of the AI, and then they're going to have all sorts of new subscription services which will offset some of the problems from the App Store. So 193, 180, 166, these are all levels that Elliott Wave says it could get to. If we erase those for a second, we see some of the other levels, other support levels. So just different algorithms, different methods telling you things that when they overlap or have confluence, pretty strong signal. My guess is that in the short run, about as bad as it gets for Apple is 200-ish. If you're a trader, you probably can buy that. If you are a long-term investor, I think you probably wait for it to get a little bit lower. One of these levels here, depending on how comfortable you are with when you take a look at the VSL and you see that the 5-year price target is about 300, which is actually the upper end of most analyst ranges, you see that the potential gain from the current price is only about 27%. Well, if you made 27% over the next 5 years, I have no idea why you wouldn't just index, right? So you don't have a very large margin of safety here, which means your risk is higher. And if we think that the bottom fishing is 150, which is what I'm going to use, that means from the current price, which is 235, you've got roughly 30% downside if, things end up not going too well. And I think you have 10-20% downside just on normal market volatility. And volatility you want to use to your advantage. So if you're trying to get into Apple you'd be looking for an opportunity to buy around 200 or lower. Certainly don't want to chase, because chasing tends to be a recipe for bad things to happen. Now, if you don't buy it here and it goes to 265, you go, oh, I missed $30 of upside. Think of it this way: you missed 11% of upside. You probably can, find that somewhere else. So when you use the VSL, you just use this column here to see what your potential gain is. I'm even going to make this all, get rid of the bold there. Who cares? Your potential gain. This is this one. We'll make this bold so that the potential gain. And again, who cares about the dividend? Seriously, that's not what we should be caring about. Let's care about our potential gain and just make the dividend our kicker. So if we scroll through here, we see there's not a lot of stocks in the mega caps left with giant upside. And why do we think that is? Why do we think that is? Because the kind of indexing. The mega caps are the ones who have soaked up all the money because of index, right? So the mega caps have really benefited. Now the indexers are going to keep buying. Why? Because they index. But what do the traders do, and what do the institutions do, and what does the smart money do when something's overvalued, but you still have a buyer? They sell, or at least trim, and then they spread their money around to other things that they think they can do better on. So if the mega caps, right, have hardly any upside, some of them almost no upside, that means there's probably going to be selling in the mega caps. You have to make a little adjustment here because of the split, right? What did Nvidia split to? Was it 10 for 1? Yeah, that looks kind of obnoxious, doesn't it? Looks obnoxious to me. Where is our bottom fishing? Well, I think that 100-ish on Nvidia probably makes a lot of sense. And can it get down in here? It actually looks like a pretty good measurement, doesn't it? What does Pitch Fan say? Pitch Fan says big outcome range. Big outcome range. I would probably buy Nvidia around 100 if I was just dying to get into it. But I've been scaling out all the way up here. Would I buy it back here? I don't know. I'm probably just buying QQQ. Look at this down here. Could it get all the way down into the 70s, 60s, or 70s again? I don't know. This range from about 100 to about 80, probably where you have to think about Nvidia again. Does it get in here, then break down? I don't know. It's an awfully good company, but they are getting challengers over the next several years. But they are far enough ahead that I don't think they're going to lose the high-end business for sure, not for a while. Not until Apple and Microsoft and Google and Facebook are all making their own chips. Are you following? All those companies are starting to make their own chips and contract out different ways because Nvidia is really expensive. I don't mean the stock, I mean the chips. So these big buyers of the AI chips, what are they looking for? Cheaper price. What does that mean for Nvidia? Margin pressure. Now, I'm not saying that Nvidia can't go up here. Certainly can. What I'm saying is that it's getting less easy to project it. So even if I'm aggressive with Nvidia and say, you know what, it's getting the 175, I can say that. I'll even put in 175. Let's be really aggressive. And let's say 80 on bottom fishing. Even if you put a projection at 175, you've only got 34% upside. Okay, let's go crazy. Let's say it's going to 200. It's still only 50% upside. Do you want that individual stock risk if something goes wrong? Right? I think that's a pretty good question. So all these mega caps, with a handful of exceptions, are bid up. You know that I've been buying Pfizer lately. Don't want any of those. I understand the argument to buy Disney. I understand the argument to buy Intel because I have a small position. Comcast, you know that I've been telling retirees to keep an eye on this one because of the dividend that should go up if the price falls a little bit more. But in general, you don't see a ton of big potential gains in the mega caps anymore. And we know that smarter money is selling into the indexers right now. We can measure it. We can see it happening. Go to Sentiment Trader or anything like that, and they can show you the selling going on, the systematic selling going on in the mega cap stocks among the executives, among institutions, hedge funds in particular, and they're spreading their bets. And that's why small caps have outperformed now for a week and a half, 2 weeks. I mean, really since that CPI print, but it was already happening since the very beginning of the month. So use this as your margin of safety indicator. These 5-year targets are not perfect, but they're legitimately in the range of outcomes And I think I do a pretty good job of adjusting these. So when we go through this, we find a lot of oversold stocks in the Russell 3000. A lot of them deserve it. You just try to find stocks. So take a look at a company like Nike. And I started thinking about something that Charlie Munger said, and I'm going to aside here to Nike because it's been on my mind. I put it on the grandpa list originally. And I just kept thinking through the company. And while I like the shoe business in general, I don't think I like Nike in general. I don't like the way they run their business. I think the brands come and go, right? They go in and out of style. And it costs a lot of money to do the advertising. So I've been taking a look at different stocks. You know what shoe stock that is really starting to intrigue me? DSW. Interests me in the shoe space is Designer Brands, which owns DSW. And this is a pretty interesting chart, right? So a lot of times it breaks up. This one broke down, but it's getting into this range. We're probably 5-ish is the downside because I have looked at the discounted free cash flow and their cyclicality and the fact, and here's, one of those things that the market will miss, that the chairman and CEO has a pretty deep pocketbook, right? Pretty rich guy. I don't really know that these are indicative of what's going on. I think what you're seeing is these downtrends are about done playing out. So I think that a price down here, 5-ish, is going to be pretty attractive. Now, can shorts beat the hell out of it? They can, but it's a profitable company. And they just made a transaction, M&A transaction. So it's a stock that I think that we should be aware of because they do buybacks and they have a patron who just keeps buying shares. So I think that this is probably close to a bottom, okay, double bottom, and we might want to be, taking a look at this one. So I got into this discussion because I started with Nike. I don't think Nike's quite as safe as a lot of people think. I think if you take a look at the performance over a long period of time, and what I'm trying to do is get you to think about these things from the standpoint of what really should we expect from this stock. This is the range before COVID, got its rally, came down, relief rally. Is this really just where it should be, right? Fell off a cliff here. Now it's dribbling out. People just aren't interested. Now, I do think it gets back to this red line at some point. But what if it just gets out there, right? It makes a shape, but it ends up here again. It might be roughly fairly valued right now. And for it to do this again, what would cause that, right? This was all that stimulus. And if we get stimulus again, like I think we're going to get at some point, isn't something better than this? Well, let's compare it to just QQQ, the basket. So even during a stimulus period, right, it didn't really do any better than QQQ. And when things started getting tough, QQQ kicked the crap out of it. And Andy Duke's book, Thinking in Bets, she talks about, okay, how do you think about each time that you're going to deploy money? And if your upside is the same with either bet, but your downside is greater with one of the bets, is that the one you're going to make? No, you're not going to make the equal upside bet that has more downside. And that's what I think Nike is. I think Nike has roughly equal upside to QQQ during good times or loose times, but has a lot more downside the rest of the time. I think you'd have to be a very nimble trader to trade this. Now, Shooter is trading this for a relief rally, and I think you can do that. But I don't know that I really have any interest in owning the company. I can trade it, but I don't want to own it. I think I might want to own DSW because that's a much more predictable business, and we know that it's super cheap. I don't know what SKX is. Yeah, somebody asks about Skechers. Yeah, I think the shoe brands are all difficult investments, right? They don't seem to have any more upside than a good index. So why take the single stock risk? All right, so let's go back here. And I am updating all these charts over the next week or two, so keep an eye on this. I'm adding a couple more dividend stocks, a couple more growth stocks. Last couple of weeks, talked a lot about energy. Really since May, been talking about energy. One of the things in energy you're going to want to take a look at are the clean energy stocks. We already know that we've been loading up on natural gas related stocks and some oil stocks. On the clean energy, there's two things I think you should think about. One, what if President Trump wins again? And that is the proper way to to talk about any president. You know that, right? You're not really supposed to say former president. Anybody who's been a president is President so-and-so for the rest of their life. President Bush, President Obama, President Clinton, President Trump, President Biden. For the rest of their lives, that's what you call them. I think pretty much all the older folks here know that. Everybody who's an Xer or older knows that that's the way you're supposed to address them. If you are a millennial, you might not know that that is the actual protocol. If there's any Gen Zers listening, hey, welcome. But that is how you address them, whether you like them or not. I think that if President Trump wins, which is a coin flip at this point, I know that everybody is betting on him to win at the moment. Still a coin flip. All the polls show that it's a coin flip. And I do think the Democrats in the next week might make that announcement that I've been predicting all along, but we'll see. Maybe they won't. Maybe President Biden is just so stubborn that he won't do what it takes to win and is going to hope to win the coin flip. I mean, maybe that's what he's going to do. It's disappointing to me, but it is what it is. They don't call me. If President Trump wins, which is 50-50, that's the first thing. The second thing is I don't think he's as bad for clean energy as you think. Who just endorsed him? Who has he been talking to? That's right, Daddy Musk. I want to give you an example of something that happened during the first Trump term. He told Saudi Arabia, I'm going to put the screws to Iran, which Saudi Arabia wanted, but I need you to pump more oil before I do it. So what happened? Saudi Arabia pumped a bunch more oil in 2018 into 19. The price of oil went way down. And then what did Trump do? He did not do the super strict sanctions and enforcement that he said he was going to do. He bluffed, and he got what he wanted, which was more oil out of Saudi Arabia. Bet you a nickel that doesn't happen again. Remember, everybody who's invested in oil, what do they want to happen with the price of oil? Do they want it to go down? No, they want it to go up. What is a high price of oil good for? Who's it good for? Not only people that own the oil stocks or trade oil, it's good for all the clean energy companies. Why? Because they become much more cost effective. The same is true for natural gas. We can see that the price of natural gas has bottomed and it's been rising for a couple months. And after a decade of flat energy demand in the developed world, and even though energy demand went up in the emerging markets, it was, small numbers. In the developed world, energy demand has been rising at less than 1% per year for a decade. Suddenly, the growth rate appears to be over 10%, maybe into the middle teens. So all energy is going to benefit. And we have to find the spots where it's going to benefit the most. High-graded, efficient oil and gas will do well, but also clean energy that becomes more and more cost-effective. Remember, technology makes it cheaper, so time is on the side of clean energy, but not on the side of dirty energy, which is harder to get. And what will Trump want? Trump will want to make money because he's not going to run again. He can't. The Constitution's not getting changed. So think through what really is going to happen. He's going to deregulate oil and gas. But at the same time, instead of flaring off the gas, now we know that the gas companies are aware that they can sell it to the tech sector and make a ton of money. So that's what they're doing. There's like 150 applications in Texas for new power generation using natural gas under their new program, which offers some loan incentives through the government. So they're going to, instead of burning it off, if they can make 15 or 20 or 30% on that gas now, that's what they're going to do. But because demand is high and getting that gas will become more difficult over time, you can watch how that industry develops in Texas and really around the world, whether it's methane from dumps or natural gas from a well. You know that gas will get more expensive because it gets harder to get. And ultimately, those natural gas plants are also going to incorporate wind and solar. So those natural gas plants aren't just natural gas. They're incorporating other types of technology, doing their own microgrids. We saw that with the Metis, right? Natural gas company with its own solar microgrid. Those are the models that are emerging. So companies like Enphase, you have to ask yourself a question. It was on its way to earning $4 a share a few years ago, got down to $3, and now it's down to $2. And its growth rate fell from in the 30s down into the teens. Is the likelihood going forward that the growth rate and profits for Enphase are going to keep going down? Maybe in the short term, but what's going to happen in the intermediate term, 3, 4, 5 years? Earnings are going to go back up to 4 or 5. Projections I see are saying $5 a share within 5 years. Okay, that would imply a growth rate in the teens, which is what they have? What if they grow faster? What if they get PE multiple expansion? Because meme, the millennials and the Gen Zers who trade already know about it, and they're just waiting for the next chance to the moon. So here's the first trade I'm making this week at Blue Mountain Asset Management. I am trying to sell the November 100 cash secured puts, get 11 or 12 bucks for them. Because I think that this number right here, see the bottom of this box? About 95, I think is the bottom fishing. Doesn't mean it can't go down to 80-ish. It can. But I'm pretty comfortable buying it under 100, anywhere under 100. I think if it actually goes under 100, I just buy it. I'll buy it outright. I think this box right here is the box. So if it comes back down here to 95, 96, I don't think you should be waiting to see if it goes down $3 more. But I'm going to sell the $100 put. My orders are in at 11 and 12. If I get it, this is the November 100 put, I'm pretty happy. Because if it does get assigned to me, then I'm getting it at 89 or 88. That's pretty close to this, everything went wrong bottom. So I think you can use the sentiment from President Trump looking like he's going to win to get a great stock cheap. So if we whip over to growth VSL, take a look, and we say, okay, what's the upside? So the estimates out there had a range of low 200s to low 300s. I like the round numbers, so you'll see me rounding to a round number a lot of times if I can, based on the technical chart. And because it's a psychological level, I do think that 95 is low right there. I think that is your bottom fishing. Could be wrong, could be a little lower, who cares? The upside to 300 is 162%. But what if earnings do go even higher than what the analysts are saying, and you get margin expansion because it becomes a meme stock again? Then all of a sudden, it's pretty easy to see that this stock could go to 500. Look at that. This is the meme area. Could absolutely get to 500. I'm not saying it will. I'm saying it could. Could also just double top in here. Add this in, and look at that. All these ranges, all these Fibonacci areas, all these support levels, all the point and figures. And all you can really do is ask yourself, do I think we get another meme on these? And I think we do. You know how I feel about climate change and what's coming. I think an event, some catastrophe, will start to drive more capital into these investments again, and maybe even change legislation, regardless of who is in the White House. Now, we have our space basket. Let's start with the one that's gone nuts. That is a heck of a rally. Probably going to do some jitterbugging. So I talked about AST Space Mobile again last April, right? Watson, I'm calling you from space. Price that day was $522. Price today is a lot higher, 158% higher. So that is indicative of it needs a breather. Take a look at the daily chart and look at this. The trajectory up, right? It's not quite as up. So right here, it's showing you different Elliott wave patterns. The price in the 11s probably makes a lot of sense to sell cash secured puts. So you need a little pullback. But if you start setting up $10 puts, and if you get a buck for them, right? Because here's your support levels down to 9, and some confluence here. That's indicative of a lot of strength. Here's a box, right? A lot of support in there. So probably 9 is the low that's coming for ASTS or higher. Maybe it doesn't get down below 11. I don't know. But if you start selling $10 puts for a buck, right? Pretty big margin of safety you're building in there. You're getting a big fat income. You probably should be making sure that you're building your position at 11, at 10, and at 9. Not quite the big differences I like to see, but I think buying around 11 and selling a put with 10 that nets you at 9, probably a good strategy. So buy the stock around 11 and sell a put so that your next tranche should be around 9. This is a big holding for me. It's grown enough that it actually is as big as my Ametis position now. And this one is on the growth. Spire Global, another stock that we talked about last year, August. Since August, it's from about $4 or $5 a share up to 12. If we shorten up this chart to the daily, right, hit that one little spike up to 17. This plateau here, though, is what it's about to break out of. And we know that's probably going to happen for a couple of reasons. This kind of buying, right, is incremental buying. That's algorithms buying the dip. And now traders noticed and push it up. Probably comes back, and then it starts to break out. I would anticipate, look at this, when the pitch fan and the pitchfork overlap like that, it's usually a really good signal. So I think that you're going to get a price here in the 20s, somewhere in here, in the next year or so. Because all these guys do is keep stacking up contracts for recurring revenue. Weather, logistics, military, space junk. I mean, these guys have a monopoly on what they do because they're not visual satellites. They use the RF, right? The radio frequencies. Clouds don't matter. So how high can this go? Hard to know. Yeah, I think it's a long time before it gets to its split adjusted price from the IPO, but I think way into the 20s and 30s. And if you bought it down here when I was screaming at you like three calls in a row on an article and an interview, you're probably net profitable. I know I am. I'm roughly up 50% at this price, maybe a little bit more. And then finally, Rocket Labs, which we have patiently been following for a couple of years. What happened last week or 2 weeks ago, I think it was last week, to their big competitor SpaceX? One of their rockets blew up. Going to shut down SpaceX for a month or two, not long. It's going to come back. There was some, unfortunately, I've seen enough stuff blow up in space now that it's almost always a seal, right? It's almost always some sort of seal. Something leaked, something exploded, and you got an explosion. Could be wrong, but they had what? Was it 900 launches in the last 7 or 8 years? I mean, they had a lot of launches, and that rocket had blown up. So I think Rocket Labs is something that you better be buying the dips on and selling cash secured puts. And the cash secured put I like are the $5 cash secured puts for, I believe it's September. Pop that up real quick. We have a lot of coverage for both Spire and Rocket Labs, right? All the places I mentioned them. Over to Option Strat if you're using that. Cash secured put, Rocket Lab, October 5, almost getting 40 cents. So 8%. My limit orders are at 50 cents. Just because I like round numbers. And I'm hoping the volatility in the next week or two gives it to me. Now, I don't think I have the chart handy, but I was taking a look at Stock Traders Almanac. And this quarter, historically, during an election year, is choppy. And then going into the election and then after, you usually get a big rally. So the year usually starts up, you get some choppiness, and then you get a rally at the end of the year. So this quarter is a quarter where I think you can be very aggressive selling cash secured puts to September, October, November. Basically sell puts on the dips. You can get pretty much fully invested. And it's not going to matter who wins. We will get a rally. The game plan for Trump: deregulate, get rid of the rules, tax cuts, continue to spend, but on the things he wants. So, Musk will whisper in his ear, and so will Ackman and whoever else is trying to buy favor. Trump doesn't care as long as he makes money. We all know this. I mean, there's certain things, I'm not saying to be offensive. I'm just saying we know certain things. Very interested in the money. Ask his son-in-law. So deregulate, cut taxes, selectively spend, leverage will increase on lower interest rates. You get a rally, probably a big one. And then the question becomes, do the tax cuts really get extended? Because the narrative will be that they are, but then we have to see the proof in the pudding. If they end up not extending the tax cuts, you probably see 2026 starting at the end of 2025 under this tax code. The tax code is going to change in 2026 to be higher taxes on the rich. Then you probably see a sell-off in end of 2025 into 2026. But then because we know that we have to fund the budget, you're going to see even more stimulus and things keep going up until there's a crash. People want to talk about bubbles in the market. There really isn't any. I know. I'm the bubble guy, man. I'm the everything's overvalued bubble guy, perma-bear, right? And I don't think we're in bubble territory yet. We are approaching bubble territories. The thing is until breadth expands, you can't call it a bubble. There's not enough things that are expensive yet to call it a bubble. As that happens, you can call it a bubble. And remember, your Magnificent Seven and handful of other stocks. I mean, I would take Tesla out of that group, replace it with maybe Salesforce or something. Those mega caps that are overvalued, it's only 50, 60 stocks. There's 6,000 stocks. Think in terms of industries and individual names, and think about where the smart money, the richest people who are selling the big stocks to the indexers are putting their money. That's where you go. And they're all very excited about space. Not only the money they can make on it, but frankly, the phallic symbolism is real. And there's money to be made here. Rocket Labs is going to challenge SpaceX, be like the little brother, right? Back when Android was most of the cell phones and Apple was like, oh yeah, we got 15-16% market share. Well, now it's 50-50, right? Or 40-40 and everybody else has 20, whatever it is. I don't know that Rocket Labs is ever going to catch SpaceX, but those alligator jaws are so wide in valuation right now that all SpaceX has to do is go sideways because it's probably fully valued for the next 10 years. And then the traders push it up and then push it down, push it up, push it down. But Rocket Labs should be an S&P 500 stock someday. That's a lot of upside. And I don't think that this is particularly this is not a particularly aggressive 5-year target. I would guess that within a year I'll be adjusting this up. The other stock that I added to the very short list is Rivian. I'm not entirely sure on how to value it yet, but it looks like it'll be one of the survivors. Will GM or Ford buy them? I don't know. Maybe. They just cut a deal with Volkswagen, right? Volkswagen. So Rivian has a place. I think the stock price goes higher. Not really sure how much. I think it gets bought. I think it has to by somebody who has dealerships, right? Ford was the original partner they had. GM makes sense. Volkswagen makes a lot of sense to me. I think it'll actually be a company that wants to break more into the American market. I think that Volkswagen deal might be a harbinger. So I think that Rivian is a stock that I might buy the dips on. It's way up today. We'll see. There's just something to it. You know, all the other companies in the EV space, startup space, are going bust. Not this one. They have the right two products. They're the perfect bolt-on acquisition for somebody. They really are. We'll see how it goes. All right, that is what I got. Somebody asked about LLAP. I don't really know anything about them. I've really moved away from anything super speculative because I don't need to, right? I just don't need to. I don't need to bet on biotechs that maybe they do or maybe they don't have a new drug. I don't need to bet on companies that maybe they do or they don't turn it around. I've really just gone away from the turnarounds and speculation, and I'm still super aggressive. I just don't need to roll dice. My guess is that Terran Orbital is rolling dice. I maybe I'm wrong. Maybe there's an edge that they have that the market's missing. That happens sometimes, but not usually. Open Doors nowhere on my radar anymore. I think the company is so poorly managed. I want nothing to do with them. If I want to make money flipping real estate, I'll do it myself. I will go hire 5 guys to flip properties with, and I'll just cut them in on the deal. Are you asking about Ethereum, Randy? So I think Ethereum can be traded for sure, but the story is not any different today than it was. Man, is it 2 years since I bought those 32 Ethereum? There we go. So most crypto has been very true to the Elliott waves. I don't know why. I guess because there's not really fundamentals. So what was it? The end of 2022, I was buying all that crypto. So yeah, I bought 32 Ethereums back in here somewhere. It looks like it's gonna rally. I mean, can you trade it? Yeah. I think the reality of Ethereum though is that the money to be made there is in owning 32 Ethereum. If you can't own 32 Ethereum, I don't think I would ever buy an ETF. I really wouldn't. But I can buy some Ethereum here. Then as the ETFs pump it up, I can sell into that wherever it gets to. But the real money to be made in Ethereum long term is as a validator and just collecting income. To that extent, it'll become like a dividend stock, be range bound, bounce around like this, right? That's what I think is going to happen. I could be very wrong, right? So young. But if you want to trade it with Shooter, then trade it with Shooter because he's really good at it. Bitcoin, on the other hand, is digital gold. It's not, right? Ethereum software as a service replacement. Bitcoin is digital gold. You can settle big transactions in Bitcoin. And you're starting to see that. I'm positive that some of the oil transactions now, which have been being partially settled in gold, I think they're also partially being settled in Bitcoin. And here's the thing with Bitcoin that I've been saying was going to happen is China just had a ruling on Bitcoin. I don't know why these don't stay where I put them. China is starting to reverse course on Bitcoin. They're starting to get pro Bitcoin again. And I think secretly they've been doing it for a while. I think Bitcoin's got a really long path up. If China suddenly comes in and says, hey, we're going to start using some Bitcoin instead of gold, and by the way, we still own 30% of it or whatever, and I think China is going to come back into Bitcoin in a big way. and so is the Middle East, and so is everywhere that doesn't want the dollar to be super strong. Now, here's the weird thing about that. I don't think it matters too much to us. If the dollar drifts down over the next 5, 6, 7 years before it rallies again, it just means that we're going to be an even bigger exporter, that our AI driven industry is going to be huge, which is why I like industrial stocks as a group. They're a little high right now from recent rally, but I think we can pick them out, right? I talked about them way back in here, and now they're way up here. So I would like to see a dip into the low 100s, maybe right here, 115. I'd probably add it to the 401k again if we got down to 115. But the companies that you can pick out within XLI or the mid caps that aren't there yet, right? Your 15 million, your $15 billion companies. Oh, I can't run for president. I just said million instead of billion. Right? Those 10, 15, $20 billion companies that aren't on the S&P 500 yet. Find one with a 10 to 15% growth rate, 10 to 20% growth rate and 20 to 30% margins. Somebody says housing and small caps heating up. Yes. And you know what I really like in housing, and I haven't done all the studying on it yet. So if you have ideas, I think manufactured housing, like the luxury stuff, is going to be a really big deal because the manufactured housing is all good for a category 5 plus hurricane. We're getting straight line winds in Wisconsin over 100 miles an hour once in a while. It's happening everywhere. So the stick builders I'm not super interested in, but I'm interested in finding a company or two or three that look like they're going to be dominant in manufactured housing and they focus on the high end, right? Where somebody who can build a really cool house for 5 or 600,000 stick built can get most of it manufactured and save 30, 40, 50%. I don't know what that means, Randy. What does that mean, that last sentence? Oh, appliances crap out in 5 years now. Yeah, is that true? I just bought new kitchen stuff. I hope it's not bad in 5 years. Paid a lot of money. Are they designing stoves to like burn out in 5 years? Is that what's happening? Are they tricking us? Planned obsolescence? Refrigerators are engineered to fail? Oh, well, that's not very nice of them. All right, let's call it a day. I wanted to talk to you about the VSL, give you some trade ideas. I think Spire, Rocket Labs, ASTS soon, Enphase soon, Rivian. Let's put it on our radar, and let's look for the companies that have really big potential upside. Then figure out how do we get into them, right? So I'm in the process of updating all these charts. It's going to take the rest of the month, but it'll get done. All right, everybody have a fantastic day. I am going to have breakfast, I think. Take care.